Top 10 Forex Trading Tips and Tricks. Forex is a combination of foreign currency and foreign exchange. Foreign exchange is a process of change from one currency to another for a wide variety of reasons. Forex is defined as a network of buyers and sellers who trade currency at an agreed price. In doing so, business and central banks are turning one currency into another. Although a lot of foreign exchange is done for practical reasons, the vast majority of currency conversion is performed in order to make a profit. There are a lot of facts out there on how traders make money and how traders lose money. The most common seems to be that 90% of the traders who lose money and about 10% of traders are reliably profitable. So, what's the 10% of them that put them on this table? As important as the question is, what is it that the majority are doing that is causing them to consistently lose trades? Number 1. Define your trading goals and strategies. One of the first things you need to do as a trader is to realize what your business goals are. Many new Forex traders are entering the market assuming that they know, but most do not even have a strategy or any clear objectives. Only after you set some goals for yourself will you start to be looking at any kind of trading methods that will help you achieve these goals. Keep that in mind, that you will try to be realistic with your expectations and ensure that the trading approach that you select suits your personality profile. Number 2. The broker and trading platform. Choosing a trustworthy broker is of the utmost importance, and it would be very useful to spend some time investigating discrepancies between brokers. You need to know the strategies of each broker and how they are going to make a market. For example, trading in the over-the-counter or spot market is different from trading in an exchange-driven market. Always make sure that your broker's trading platform is appropriate for the research that you want to do. Number 3. Take a top-down approach and utilize multi-time frame analyses. Regardless of whether you are a day trader, a swing trader, or a long-time position trader, you should still seek to take a top-down approach to market trading. All this literally means is that you start with a higher time frame chart and zoom down from there to your time frame chart. It will also give you a broader scope from which to view the price action. Most traders make the mistake of making trading decisions based solely on the period in which they are trading, i.e., the duration of the signal. In order to increase the possibility of winning an exchange, it is often appropriate to evaluate several time frames. What happens sometimes is that you can either weed out bad trades on the basis of a higher period chart review or get more confirmation of your trade. Either way, you are likely to improve your odds of winning trade by taking a top-down analysis approach. Number 4. Test your strategy and know your expectancy. As traders, our job is to find high probability settings and execute them without letting our emotions get in the way. That's it, really. Yet to get there, you've got to realize that trading is all about managing risk and understanding the probabilities. It is only through rigorous testing and evaluation of our Forex trading strategies that we can be comfortable in trading and sticking to it for a long period of time. Boost your chart pattern recognition skills when you finally graduate from live trading. When you've logged out of all trades and checked at least 100 trades, it is then time to evaluate the performance and work out the trade expectations. Number 5. Take control of your emotions. Don't get carried away with it. It can be difficult at times, particularly when the loss is felt, but maintaining a reasonable, calm head is important. As feelings get stronger, subject yourself to unnecessary risk. Unlike markets with hundreds of thousands of different shares, Forex operates with 8 single currencies that are the core of most transactions. It is obvious, but real. Trading under stress usually leads to rash decisions, and that will most likely cost you money in a live trading situation. Identify the source of tension and try to get rid of it. Take a deep breath and concentrate. Number 6. Practice makes perfect. This is the most valuable tip that we can send to anybody. Remember, it is very unlikely to succeed at anything that you're going to do at first. Constant trading activity reliably delivers good results. When planning a next step, evaluate market dynamics and explore your own psychology. You've got to ask yourself the following questions. Have I shown signs of confirmation bias? How I made a deal out of frustration? Which made me pick the currency pair? Mastering your psychology will shield you from any setbacks in the development road of trading. Number 7. No risk, no success. Not even the top 100 Forex trading tips and tricks will guarantee your success. The probability of failure has to be acknowledged. You're not going to be successful transactions 100% of the time. Do not let the fake commercials get into your ears. Be realistic about your trading plans and targets for Forex. Success is never an intermediate, or there is never a simple or fast route to income. Stay patient. Number 8. Keep your trading simple. As a Forex trader, you soon learn that the use of metrics in trading is often counterproductive. The most efficient traders would inform you that the best indicator is the price, and that every other indicator on your price is the common commodity derivative itself. So in the trading world, where getting in before somebody else does is always the difference between successful or losing trades. Trading doesn't have to be complicated. If you can learn to read price action and understand the basis of price movements through supply and demand imbalances, you'll be well ahead of 90% of Forex traders out there. Hopefully at some stage in your trading path, you will be able to focus on price action on your own, using simple support resistance zones and supply and demand rates. Number 9. Know where the key support and resistance levels are. Understanding support and resistance is one of the main principles for trading. Support and resistance is characterized as a key price level where both the buyer and the seller have expressed interest and traded enough volume that has caused prices to either stop or stop and reverse, causing a significant swing. The trader would use these levels to gauge future price levels where buyers and sellers are likely to enter the market in the future. Horizontal price lines can be drawn where the price has been traded and reversed to create an important support or resistance zone to be closely monitored. It should also be noted that the higher the time frame in which the main support or resistance level is established, the more accurate it is. In addition, the majority of market players who can adjust rates, such as the hedge funds or other companies, prefer to watch the level of support and resistance generated on the daily charts. Number 10. Focus on trading price action in the markets. It is the key Forex trading lesson that any newbie should be paying close attention to. Several new traders are being consumed trying to find the ultimate trading predictor, the one that will eventually put them over the top. The problem is, this is a futile search. Sooner or later, this truth will become clear to those who are looking for the Holy Grail. The best market tool available to us as traders is simple price activity beats, any mix of RSI, stochastic, MACD, or whatever. The explanation is that both of these metrics are determined from the price itself. And what's the point of a middleman, which is essentially what metrics really are? Depending mainly on price action, you are going to start seeing it far more clearly. There is no question about that. Think about it. The machines haven't been around for that long, maybe 50 years or so, but the financial markets have been around for hundreds of years. Back then, trades used to read the exchange tape, and they would research how the price was going to gauge the overall direction of the market. Thanks for watching. If you liked that video, hit the like button and share. And for more videos, please subscribe to our channel.